Alright, what is up everyone? Welcome back to another video. My name is Darren, and today I'm going to be talking to you about dividend investing and the power of compounding. Right? So I'm pretty sure you guys have heard of dividends and dividend investing, but let's dive deeper into how powerful it is to actually be investing into dividends, stocks, and the power of compounding them. So first off, let's have a introduction about what is dividends. So dividend is basically income paid in cash by the companies to investors. So basically, a company will make a profit every year, and from the profits, they can decide whether or not they want to retain the profits in terms of cash, or they can choose to pay it out to investors. And if they decide to pay it out, that is what we call as dividends. All right. So basically, it is a very it's a very interesting idea because when you invest in a company that pays dividends, no work has to be done by you, right? It's not like you work for the company. It's not like you have to contribute to the company. No, you invest in their company shares, you buy their shares, and they pay you their profits. So it's very passive. And another thing that is very interesting about dividends is that it is tax free, or at least in Malaysia, it is tax free. So meaning the amount that they pay for you, they pay to you, you don't have to pay a single cent on tax on it. And lastly, dividends are usually paid quarterly or half yearly by companies, right? So this is just the idea of what are dividends, so you can get an idea. So aside from dividends, we want to talk about the power of compounding. So now a lot of you might not know what is compounding. So or if you have heard of the word compounding, you might not know the effects of compounding. So let's imagine a scenario if you had invested $10,000 into the stock market and you reinvested $1,000 monthly for a period of 10 years. All right, do this for 10 years and you receive a 3% return on investment per annum, which is very conservative. All right, but we just want to illustrate an idea. Now, by doing this, after 10 years, you will actually have $151,000 in your portfolio. All right, now this might not seem like anything, but let's illustrate it on a graph. All right, so this graph, you can see that the red line shows you the growth of your portfolio value from year 0 to year 10. And the green line, the straight line, shows you the amount that you have contributed throughout the years. All right, as you can see, it is relatively flat. But notice the significant thing about the graph is that the red line is diverging away from the green line, which means that your portfolio value is growing faster and faster than your contributions. That's why it's increasing the gap between the portfolio value and the amount of contributions that you've made throughout the years. So this is just basically what I mean by compounding, which means that you reinvest the amount of money that you get from investing and use that money to get more money. Basically, the simple idea is basically use the money that you get, invest it, get more money, to invest again, to get more money, and do it over and over and over and over again. All right. So this effect right now might not seem like very obvious or very significant, but imagine if you do this for 30 years instead. How much would you get after 30 years? Well, after 30 years, you will actually be getting almost $595,000. Now, looking at the graph is more important. All right. You can see that after 30 years, the distance between your portfolio value and your contributions have increased significantly. All right, so I hope now you guys can actually see the power of compounding behind this graph. You can see that your portfolio value is curving upwards while your contributions, because it's consistent and the same every month, right? So it increases in a straight line, but your portfolio value is not. And that is the effect of compounding, which helps your money grow in an exponential way. All right, so that's basically the idea behind compounding. All right. So how can we use the effect of compounding and the power of compounding on growing our dividends, right? Which is basically the amount that we receive from companies. Or just imagine if you have invested in a dividend paying stock that pays you a yield of 3% per annum. Now, after receiving your dividends, instead of spending it or saving it, you reinvest those dividends along with the monthly contributions that you make. All right. So it's no longer just your monthly contributions of $1,000. Imagine it's $1,000 every month plus any dividends that you receive. Just imagine how much dividends would you actually be receiving after 10 years, right? Just get that idea into your mind. So to illustrate this, we actually did a case study on a live example, and we actually did it on Public Bank of Malaysia. So Public Bank of Malaysia is actually one of the largest bank in Malaysia today, with a market cap of about 77 billion ringgit. All right, it is one of the largest banks besides Maybank. All right, now the reason we decide to go with Public Bank, not only because it's one of the largest banks in Malaysia, but it's also because it is a blue chip company that has solid earnings, solid and consistent, and also increasing earnings year after year. And not only that, they also pay solid and consistent dividends every year. And one of the interesting thing about Public Bank, which is also one of the reasons why we actually decided to go with Public Bank for our case study, is that Public Bank actually pays increasing dividends every year, which means that since 2011, their dividends have actually been increasing every single year up until 2019 and before the pandemic hits. Now in 2020, they paid a lower amount in dividends due to the pandemic and economic issues. So they decide to conserve cash. So the dividend amount is actually significantly lower. But the idea behind is the same. Public Bank pays increasing dividends. So how we did the case study is that we asked ourselves, what happens if we had invested 10,000 ringgit into Public Bank on the first day of 2011, and after that, every single month, we put in 1,000 ringgit to dollar cost average our portfolio, which means that every start of a new trading month, we put 1,000 ringgit into buying Public Bank shares. And not only that, we also reinvest any dividends that we receive immediately, which means that if we had received dividends this month, we would invest our dividends in the following month, along with our monthly contributions. And we asked ourselves, what would our portfolio look like at the end of 2020? All right, and not only that, how much dividends would we be increasing? Sorry, how much dividends would we be receiving after 10 years? Has it been increasing, decreasing? How much has it been increasing? All right. So the results of our case study is that after 10 years, at the end of 2020, our portfolio of just Public Bank shares would be worth about 183,000 ringgit, all right, including dividends. And throughout the 10 years, just by investing about 1,000 ringgit every month, the total dividends that we receive after 10 years is actually 26,000 ringgit. 26,000 ringgit just from dividends, which means that this amount of money is given to us for free. We did not have to do anything for it. And by dollar cost averaging throughout the past 10 years, until the last contribution at 1st of December 2020, our portfolio of Public Bank shares has an average share price of 3.49 ringgit, which means that in today's market, our portfolio will actually be making a profit. All right. So this is just a graph to illustrate to you the difference in growth between our portfolio and the contributions that we make. So you can see the contribution is in a straight line, while our portfolio is growing further and further away from our contributions, which means that the effects of compounding can be seen in our portfolio growth. All right. So this is our portfolio growth. Let's look at the dividends that we receive. Now, very, very surprisingly, our dividends have actually increased 1,100% from 2011 to 2020. So here's a graph to illustrate the amount of dividends that we have received each time from 2011 up to 2020. And you can see in the first year, we've only received 267 ringgit. But after 10 years, in 2020, we have actually received 3,000 ringgit in dividends. Now, of course, this is a one-time dividend only because in 2020, Public Bank decides to cut the dividend amount paid. So looking at 2019, which is these two bars here, we can see that we will actually be receiving almost 5,200 ringgit in dividends in 2019. All right. So just imagine that how much your dividends have grown just by reinvesting your dividends and contributing the same amount throughout the years. You contribute only 1,000, but you reinvest all your dividends. And you can see the growth is exponential and is very significant. All right. So just imagine in just 10 years, it has increased almost 12 times in dividends. So imagine in another 10 years, will your dividends be growing to almost 30,000 each time it is paid to you? Just imagine that. All right. It's very possible. So, but the idea is that compounding can do this for you. Compounding can help you increase the amount of money that you receive over time. All right. So that's basically it. This is just a very short video. And to summarize what I've been talking about throughout our video is that compounding is a very powerful tool for any person to grow their wealth exponentially. All right. You have to use compounding in order to grow your wealth and beat inflation and to see significant returns from your money. All right. And to capitalize on the effects of compounding, time spent in the market is the most important thing. Meaning that just like how we've illustrated before, if you've only done this for 10 years, the difference may only be small, not significant, nothing too impressive. But do the same for 30 years. The difference starts to make sense. The difference starts to impress you. All right. This is basically what we mean by time in the market. All right. So it's very important to stay invested or to invest as early as possible to capitalize on the power of compounding. Basically the snowball effect. Once you get the ball rolling, the longer it stays rolling down the hill, by the time it reaches a certain period, the ball just becomes big enough to destroy everyone. All right. And finally, for any dividend investor, the goal, the dream is to finally live off of your dividends. Basically, have your dividends that you receive every year be able to cover and pay for your living expenses, to survive off of your dividends. So that's the goal, that's the dream. All right. So yeah, that's basically it for today. It's just a very short video to just basically show you how investing can be very simple and investing can be very hassle-free, and how by investing as early as possible and to stay invested, one can actually grow their wealth exponentially to a certain level. All right. So I hope you guys understand the video, and if you actually like the video, just give us a thumbs up. And if you have anything that you don't quite understand or you would like to ask us about, drop it down in the comment section below and we'll get back to you. All right. So that's basically all for today, guys, and I'll see you in the next one.